Welcome back to the podcast. I'm joined by Ernest Wong. How you doing today?
I'm good.
This is going to be our last podcast of the year. So sad. The year has come to an end. We will have vacations and holidays coming up, but we'll be back at you in the new year and hopefully have a fresh new look and try out some new things. But we really appreciate everybody who listens, all our clients, everybody who follow us. And as always, please subscribe to our podcast on Apple and Spotify and YouTube. Please leave us a 5-star review. It really helps, and it really helps others find our podcast, and it allows us to continue to grow and be motivated to continue to do this going forward. So, Ernest, were you motivated by a good year in the markets in 2024?
Well, it's interesting because every time the markets go up and your stock picks go up, then you feel like you're doing something well.
Yeah.
And then when they're down, then you feel kind of depressed, and you wonder if you did something wrong.
Especially in a bull market, right? So in a bull market, if your stocks aren't up as much as the market, you're like, what did I do wrong? Exactly. Or if you have God forbid, a stock that's down, am I a moron? Right. And so in lousy markets, you actually, even though the feeling stinks, you feel fine if everything's down, right? Because everybody gets hurt. I guess, we need to realize that in a bull market, none of us are geniuses. The wave goes up, we're on the surfboards, we're riding that wave, and hopefully we don't crash and burn.
And that's the difficulty of investing in stocks broadly, is that it's really hard to know exactly whether the stock went up because you nailed the thesis or because everything was going up.
Yeah.
And there's many such cases this year where you can look at Spotify, for example. Spotify's up a lot.
Yeah.
And I think there were a lot of people wondering, well, what did we miss with Spotify? And I think Spotify's executing very well on many metrics, but the real answer is that everything is up.
Everything is up. And some of those names maybe that went up a lot in 2021 that got destroyed in 2022 now are at all-time highs again. I don't know what you can learn from that. It's that money flows into, maybe they're really good business models. They're good ideas. They're going to work out long-term. Maybe they're expensive on valuation. Maybe the market's going to get it right. For every company where someone would say, oh, it's way too expensive, or, you're ludicrous, all right? You could have said that about buying Amazon 10, 15 years ago, right? Or buying Tesla 10 years ago and paying such a stupid multiple, and yet they've worked out. So you just don't know.
No, you really don't. And to the point about not knowing where the market goes, I remember in 2015 when I went to the Berkshire Hathaway annual meeting. That was the only one that I've ever gone to. And I went to a cocktail reception the night before the meeting.
Okay.
And there was almost unanimous consensus among all the people in the room who were well-regarded analysts and portfolio managers at firms that people know, that it was a really difficult market to make money in because everything was at all-time highs and very expensive. And of course, the market continued to go up from there.
That's right. And, there's a lot of doom and gloom people that if you go back and see what they've said over the years, they'll tell you, oh, no, this is the year the market's going to go down 25%. No, it's going to go down 25% for sure, right? So it's very easy to say that the market is expensive because optically speaking, the fundamentals are expensive, but we're in a bull market, and that's what happens in bull markets, right? You can't have it both ways. You can't have a bull market in cheap stocks, and you can't, right?
By definition.
By definition, right? So it's just annoying that everybody calls it a bubble. Just call it for like it is. It's a bull market with pockets of stupidity, pockets of silliness. I've been around long enough. You've been around almost as long enough now that we've seen pockets of silliness in every type of market, even bear markets, even, calm markets where there's just people throwing money at the stupidest investments that you can come up with and overpaying for things. And that's just going to happen. Maybe it's more of the case in a bull market when everybody is following the momentum, but that's just the way things are.
But there is quite a bit of silliness in the markets today.
Okay.
I'm thinking about the example of things like crypto markets, where there are these instruments. Well, I don't even know if instrument is the right word.
Yeah.
But there are these tokens being sold that are obviously scams,
Yes.
where the creator of this token doesn't even pretend that it's not a scam,
Yeah.
and people are still bidding them up to multi-$100 million valuations.
Yeah.
And to me, that, like, I don't really understand why people are buying these things, but they are, and
Well,
it's going to end badly.
Is it any different than the GameStop type meme stocks that flew up a couple of years ago? Is it just the same thing where the greater fool theory? There's a lot of money being thrown at one direction, and then of course the big money may pile into it too because they can force the suckers to get the price up, and they'll get out before you do.
No, I think that's probably what it is.
Yeah.
And especially given that much of the crypto space, to me, doesn't appear to have any actual utility.
Yeah.
Like, they're not generating cash flows or dividends or anything of that sort.
You're going to create a lot of Bitcoin enemies right now, but yes.
Well, Bitcoin, I think, has some use cases, but the vast majority of the crypto world, even the people who are enthusiastic about the space would agree that there's no use cases.
Well, right? And there's such hyperbole, people saying it's going to go to $1 million a Bitcoin. Okay. I mean, why not $1 billion? Why not $1 trillion? If you're going to go crazy and throw out a number, go extra crazy, right? It's impossible to value a Bitcoin. It's supply demand. Maybe there'll be more supply. Maybe there'll be more demand. I don't know.
Maybe quantum computing will make the whole thing extinct.
I don't even know what quantum computing is, but clearly Google thinks they have the ability to solve complex problems very, very quickly. And isn't that what a Bitcoin is? It's solving a complex problem to create this Bitcoin. It's all nonsense to me, but whatever. What do I know?
Yeah, let's not get into that.
Okay, so we're not going to get into that. We focus, and you may be asking yourselves, what does any of this have to do with long-term investing? It's all part of investing, whether we like it or not. There's going to be speculation. There's going to be assets that we don't agree with. There's going to be, momentum, and people are going to make money and lose money in different things. We can choose to participate or choose to ignore it, right? But for us, what makes sense is to own investments that have cash flows, that have the ability to reinvest those cash flows, that are run by strong management teams that focus on the long term. And that's the pockets we're going to play. You tweeted the Buffett quote. Isn't that the point you're trying to make here?
Yeah, the quote was, Buffett's made a famous observation that the size of your circle of competence doesn't matter that much. So in terms of, like, if you don't know how to evaluate cryptocurrencies or like artificial general intelligence or robotics or any of these kinds of things, like, it doesn't matter. Like, you don't have to have an opinion on these things if you're an investor. But what is important is staying within your circle of competence and knowing what you are capable of evaluating
at this point in time. And you can obviously increase your circle of competence. We always say here, you don't have to have an opinion about every single publicly traded instrument or private instrument. You don't, and you can't possibly. But it's our job also as investors to increase our circle of competence and learn about these new technologies and these new asset classes, and to get an understanding and to determine whether we think it's just some kind of old thing wrapped up in a new package, or if it's something worth paying attention to.
Exactly.
Yeah. So the year. Let's getting back to actual topic of. I think this is going to be our year-end wrap show. We're going to talk about things that worked for us, things that didn't work, things that surprised us, things that disappointed us. Maybe even give a little things that we're thinking about for 2025 as we head into 2025, and really talk to our clients about setting right expectations. And I think right off the bat, just important to set expectations, right? Markets have been very strong for 2 years in a row, and no one should get used to making 30% a year. Right. And no one should call up their advisor and be mad at them if they didn't make 30% in 2025, because that's not going to happen. It could happen, but it's, what is the long-term returns of equity markets? 8 to 9%?
Yes, in the U.S. market.
In the U.S. And so that should be your reasonable expectation going forward, right? And so there'll be some type of mean reversion, whether the market goes down or doesn't do anything for a long period of time or doesn't go up as much. Hard to know. If you look at the last 5 years, S&P 500 performance, terrific. The next 5 years could be even better, could be worse. You and I don't know.
No, and we really don't. I think the big theme for 2024 was that coming out of 2023, I think everybody was still kind of scarred by 2022 and what was going on
For sure.
for that year.
For sure.
There was kind of geopolitical issues. There was lingering doubts about inflation and interest rates.
Yes, good points.
And the outcome of the U.S. presidential election. And I think in 2024, the market seems to think that most of those issues were resolved.
Yeah.
Interest rates are coming down. Inflation's coming down. The U.S. economy remains, I think, quite strong on most metrics.
I think that's true.
And the market seems currently enthusiastic about what Donald Trump might do for equities. So
it also seems enthusiastic about just the outlook for the bulk of the S&P 500 companies. Profit margins are increasing, ROEs are high. The big tech companies are still, according to the latest earnings report, still knocking it out of the park. And the demand, there's a lot of interesting themes happening, right? AI, electrification of the grid, renaissance in U.S. manufacturing and construction. These are good things that help corporate profits. And why you should always never confuse Main Street with Wall Street, right?
Yeah.
Yeah.
I think what was maybe a little more surprising to me was how strong the TSX was. I think it was up as of today. It's up about 25% year to date.
Yeah.
And that certainly does not correspond to the narrative that you're hearing about with regards to the Canadian economy, where I think the narrative is that productivity is terrible, GDP per capita is terrible.
Yeah, the government seems to be in shambles. No one can get along.
Yeah.
There's a lot of strong opinions about the government. Also, potential of rising corporate tax rates.
Yes.
These are not necessarily things that would, if you told me all these negative things that would happen, and then, and the TSX up 25%. So the question is why, Ernest? Why is the TSX doing so well this year?
Well, there's I think it's important to remember that the TSX is quite a top-heavy index, where the top names, this is true in the U.S. too, but the top names of the TSX really drive a large portion of the index performance.
Okay.
So
it's a market cap weighted index, and
Yes.
so the big names have the biggest influence. The biggest names: Royal Bank, Shopify, Enbridge, Brookfield, Constellation Software. Thomson Reuters out of nowhere.
Yep, these companies are all having their stock prices are up a lot for some maybe for a variety of reasons.
Yeah, really the only lousy performer in the top 10 of the TSX is TD Bank.
Yes, and they obviously have the regulatory issues in the U.S.
But still, on an overall return basis, I don't think it's down that much. What's surprising to me with the TSX this year is just the strong comeback in the Canadian banks, right?
Yep.
And so we did podcasts on this, and there was worries nonstop about how interest rates are too high, and as these mortgages come due in 25, 26, 27, there's going to be a disaster, and Canadians aren't going to have enough money to pay for groceries. Meanwhile, grocery prices have gone up anyways. But I think the banks got saved, of course, by some significant interest rate cuts in Canada. And Ernest, we expect tomorrow, Wednesday, I think, what's tomorrow? December? Who knows? Anyways, tomorrow they're expecting another big interest rate cut in Canada, the last one of the year, and more to come. So that really helped, I think, the Canadian bank stocks.
Right. I think the main driver of the Canadian bank stocks has been the expectation that because interest rates have been cut and continue to be expected to cut, this really removes the worst possible scenarios that could happen for Canadian housing and the Canadian economy as a whole.
Yeah.
And you can have your opinion about Canadian housing, right? I don't really want to get into that here, but I think the reality is that now that homeowners maybe have like a little bit less risk in terms of renewing their mortgages, that's going to help them go out and spend on things like cars and TVs and the economy overall.
For sure. And so banks, as you know, are driven by loan losses. And when things are really bad, the banks have to start taking massive reserves against a potential default from businesses, from residential customers. But that doesn't look to be the case. And good news is our neighbor, the United States, is doing quite well. So for now, and there's no tariffs yet, we'll see what happens. But for now, there's really strong flow of goods. And that's another thing, of course, worries about tariffs. Nothing has seemed to have stopped the TSX this year. Also positive, Ernest, is the dropping interest rates have helped some of those dividend payers as well that have been hurt. Probably the names that have cooled off a bit are maybe some of the commodity names, right? Copper prices have come off a little bit. Oil and gas stocks have come off as energy prices. I guess there's less concern about Middle East issues, less concern about the flow of commodities from the Russia-Ukraine area. So and maybe some concern that there's slowing economic growth.
Right. To your point about commodities is that in 2022, when potash prices were soaring because of the conflict in Russia and Ukraine, actually, I did like a call with an expert in the area, and I asked him, so, like, what's the risk that, like, because of the conflict in Russia and Ukraine, that like fertilizer prices just permanently stay high because like Russia is not allowed to export these fertilizers anymore.
Okay.
And he said, basically, it's not going to happen.
Yeah.
Right. Like fertilizer is just such a fundamental commodity to how people live that there's no chance that even the European countries were not going to buy Russian fertilizer.
So it was going to find its way into the market somehow.
Yes.
And so as a result, fertilizer prices have come down a lot.
Yep. So,
and these are good things for inflation. So yeah, it has turned out to be a year, Ernest, where pretty much a lot of things have worked. Bonds, for the first time in a while, strong performance. Gold, strong performance. Bitcoin, obviously, strong performance. All types of markets. I think a lot of emerging markets are doing well as also. So it's a good news story year. Will some of that reverse next year in 2025? We don't know. But we'll get into maybe some our thoughts in a few minutes about outlook for 2025, if we can be so bold as to make a few predictions. Ernest, do you want to talk about some portfolio changes and get specific about, I think we talk about some of the stocks in our portfolio that maybe surprised us, disappointed us, some changes that we made, as well as maybe some stocks that we feel are bound to have a better 2025 or some interesting things that we think could happen to them. You want to kick that off?
So 2024, we bought 5 new companies in the portfolio, in the core growth equity strategy.
I think that was one of the busiest years for us. You've been busy, boy.
And we sold 4 of them, I believe.
Yep.
So as you pointed out, this is an abnormally high turnover for us, which is roughly, I want to say, about 10-15% portfolio turnover.
Yeah.
Which implies, by the way, like a 10-year holding period.
Okay.
So it's still quite low.
Okay, very good. Yep.
But this was I think if you look back to the beginning of the year, there was a lot of concern about divergence in market performance, right? You had companies like NVIDIA and Amazon and Apple, like they were really driving the market. And you had this whole wasteland in the smaller, maybe less sexy type names that had really suffered from 2022 and hadn't really rebounded.
Okay.
And so I think the way that we looked at the portfolio was that there were a lot of companies that we had admired and had studied for a long time that we had the opportunity to buy at fairly attractive prices relative to the market and relative to also what we had in the portfolio.
Okay.
And so
great setup. Yeah.
So we took that opportunity to make a couple of changes. So we, early in the year, was it early in the year? But we sold BlackRock and we bought MSCI, which is, we've talked about on this podcast. We bought Alimentation Couche-Tard. We bought Garmin and we bought TransDigm.
Yeah.
I think we've done podcasts on all of these companies before.
Yeah.
And I think that sets us up really well for the future.
Garmin was one that really surprised me. I think the stock doubled since our initial purchase.
Yep.
I can't remember if
Up
it was
71%.
Oh yeah, I remember buying some shares at $100 a share. It's now 210.
Yep.
Yeah, is that 71 or is that 100%? Anyways, that's it's done really really well. And this was one at one point in time, Ernest, during the year where analysts kind of cooled off on the name, thinking that maybe some of their consumer products were, people had pulled forward demand and they couldn't see how that was going to continue. And then Garmin released just another strong quarter. So you had a conference call or a call with the investor relations recently on Garmin. What was the update? What was the interesting insights that you learned?
Well, I think they said it's just business as usual.
Yeah.
They like the strong performance. They didn't surprise them because they're working on these new products all the time. And next year they expect it to be another good year of new products because that's what they are. Like the products that did well this year, like the engineers have already moved on from that and they are thinking about, they're working on the next iteration of the outdoor watches and the boating lights and whatever, right?
Yeah.
So I think the most interesting thing about Garmin to me is that they are still buying back stock at current prices. There are some companies, like the best companies that I like are those where the management owns and the board, they own a lot of stock and they basically tell you when they think the stock is cheap based on when they're buying back stock, right? And Garmin is one of those companies. Like if you look at
there's good signal value based on insider purchases.
Yes.
Yeah.
Because they already own a lot of stock,
Yeah.
like they would only be buying back stock if they thought that it was undervalued.
Yeah.
And Garmin has a good track record of buying back stock when it's low.
Yeah.
Not buying back stock when it's expensive. And the fact that they're still buying back stock today, like to me is an indication that they think that the future is still quite bright and the stock is attractive, even after the run that it had this year.
So to go along with that, MSCI, newish purchase in our portfolio, one where we talked about on our investor webinar, which I hope everybody checks out. It was wonderful, where Ernest presented MSCI. We were following that stock for many, many years. This is a one where the company gives you a good signal value of buying back its shares. When we bought the shares earlier this year, it was at a time, we found out later, where insiders were actually buying back the stock at the same time.
Yep.
And I just saw the CEO, Henry Fernandez, at near a 52-week high. He's buying more shares. This is a guy who, I don't know if he's a billionaire yet, but he's worth a lot of money, and he's buying still more shares as CEO of the company. So these are what you want to see, right? On the other hand, there could be signal value of Buffett selling Apple or Zuckerberg selling some Meta or Bezos selling Amazon, but we don't know why they're doing it. Maybe they're doing it because they're so ungodly rich and they need to pay some taxes. Did you know, Ernest, that a lot of these guys, like Elon Musk or Bezos, they don't have cash flow, right? All they own is investments. Like Amazon doesn't pay a dividend, so there's no cash flow coming in. He's got to sell, and these guys probably live off a lot of borrowed money, right? Yeah. So they got to cover their interest at some point in time.
Yep.
And so you never know what the rationale is, but if you were worth $300 billion, you might take some money off the table once in a while.
I'll tell you when I get there.
Okay, cool. So yeah, I mean, what interests me, and I hope clients can take away from this, is a number of all the names that we bought in the portfolio this year: Meta, Couche-Tard, TransDigm, MSCI. What else did we buy?
Garmin.
Aside from Garmin, so 4 out of the 5 names were companies that we've been watching for a long time.
Yep.
It wasn't something where, like Ernest said, let's buy Meta, or Barry or I said, let's buy TransDigm. These are names that we had researched in the past, followed in the past, maybe even presented to the investment committee in the past, and then, maybe had to refine our pitch and get comfortable. Maybe there was issues in the past. So you're allowed to follow stocks for a long period of time and make the decision when you're ready.
Yep.
Yeah.
Yeah, and I would say the names that we sold are generally more mature companies. These are like companies like CN Rail, companies like Vail Resorts.
Yeah.
Like they're reasonably well-run companies,
Yeah.
but have less inherent growth opportunities ahead of them.
Yeah.
So I do think this sets us up quite well for both 2025 and the future, because the companies that we buy are secularly growing companies with long growth opportunities ahead of them.
And let's keep in mind that we didn't sell Vail or CN Rail or pretty much anything else this year because we thought they're lousy businesses, or that I don't think we sold them because we thought we made some kind of fundamental mistake with them, or that we think the future is going to be worse going forward. We just think that possibly based on our analysis of intrinsic value growth, it won't be as much as maybe some of the newer names in our portfolio.
Well said.
Is that a good? Yeah. Okay.
Yeah.
All right. So that's a good interpretation of what we're trying to do. Luckily, we didn't have any disasters this year.
Well, it's hard to have a disaster. This is one of those years where if you had a stock, instead of asking like, why is my stock up 30%? Like, I think a better question would have been to ask, like, why did the stock that not go up?
Yeah.
And we have a few of those in the portfolio.
Of course. And it's like kind of annoying when you look at something that's up 20% and maybe you're made to feel bad about that, right? It's up 20%, but yet the S&P's up 30%. And so you underperformed. I'm like, come on, man, up 20% is amazing. But this year there's a few more weeks left to go, but there hasn't been any name that's gotten destroyed. There's been lots of volatility for sure. And stocks have moved around. Like at one point in time, I think Apple was back down to 170. Now it's 240. Google was down to 130. I mean, things have gone up and down a fair bit. Although I am actually surprised how calm a year it's been on the market. I think, Ernest, we've only, December's not over yet, but I think we've only had one negative month for our clients the entire year. So something to be pleased about. So a quick review. I don't think we did a 6-month review. So I don't think much has changed. Unfortunately, some of the names that underperformed year to date are still underperforming. And those are restaurant brands, CoStar and Adobe. I think we touched on those names. Those are companies that we've done podcasts on in the past. We've mentioned, I think for Adobe, Ernest, part of the reason why it's down is because it had such an amazing year in 2023. Stock pretty much doubled it off the bottom from 2023 to the end of beginning of 2024. And so the stock, has cooled off. CoStar still trying to monetize its homes.com. We've talked about that ad nauseum.
Had an investor day.
So any new updates on that?
It was a weird day.
Yeah.
Because usually during an investor day, what everybody actually wants to hear from the investor day is like, what do you think you're going to grow over the next,
of course,
3 to 5 years? Let's say.
Of course, give us some guidance.
What's your earnings going to be like? What do you think you're like? How do you think you're going to spend your money?
Yeah.
And CoStar gave zero financial data during the investor day. No targets.
Didn't pump didn't pump their stock whatsoever.
Yeah. So I was talking to somebody on Twitter. Who also follows CoStar, and I said, it shouldn't have been called an investor day, right? Because analysts fly there and they want your EPS targets for 2028, but what this should have been called is a product showcase. What CoStar really did was that, they highlighted a bunch of the leaders that they have in their divisions. They highlighted some of the the more hidden divisions that people are not really paying attention to, such as their lands business, their small business, marketplace.
So they have another marketplace called lands.com where people can buy free range land. And
it's the largest marketplace of land in the US.
Yeah.
So they kind of highlighted these kind of platforms that they have.
Yeah.
But they didn't talk about residential that much, and they didn't really talk about apartments.com that much.
But they did talk residential ad nauseum in a number of meetings with investors over the last few weeks, right?
Right.
So I guess maybe they felt like they're already beating a dead horse, so to speak.
Yeah.
The takeaways that I got from reading some of the transcripts, not from the investor day, but from the investments that they're thinking about homes.com is, the marketing spend is still going to be big in 2025, but on a relative basis, maybe not as big as 2024. They recognize they got a big cash balance. They're thinking about something they're going to do there. They recognize that the market obviously hates the investment in homes.com at the moment, but they feel really bullish about it. And they also feel confident that if it doesn't work, they're going to pull the plug.
Yep.
So that gave me comfort that the management is not ignoring the concerns that institutional investors and the regular investors like us have with the growth, but I think they did do a great job of explaining, hey, homes.com, not so great. Some of our parts of our business are being affected by just a tough marketplace, but other parts of our business are doing incredible and you're not recognizing it.
Yeah, I think one of the slides that they had showed the revenue growth of the core business, excluding residential, throughout multiple commercial real estate cycles. And I think that's really what the story of CoStar is that they have a strong track record of being able to grow the business, even in a very, very tough commercial real estate market.
Mm-hmm.
And, we'll see what happens with homes.com, but at the end of the day, it's a very high quality business, and the market's not really paying attention to that.
And the final name, Ernest, to talk about where it's kind of underperformed is Restaurant Brands.
Yep.
Similar to Adobe, it did have a good 2023. The stock reached an all-time high, I think, in 2023. So it's pulled back a little bit. Is it really has to do with just a tough market for the low-income consumer who is affected and is not going out to fast food restaurants as often?
Yeah, I think what happened with Restaurant Brands is really a broader story that you hear from retailers across like multiple industries, including Alimentation Couche-Tard, the convenience store industry, across like companies like Dollar General, across McDonald's even, is that in the US, the lower income consumer is struggling. Like they got hit by inflation really hard in 22. Incomes haven't really risen corresponding to that. And they just don't want to spend as much on things like fast food or even shopping overall.
So how are they rectifying that? Offering more value deals, more value for their people's money?
Yep.
Yeah.
And so the performance of Restaurant Brands has actually been quite good.
The fundamentals, not the stock price. Yeah.
Yes. Yeah. Like they're still going to grow operating profit this year. They've turned the corner on Burger King in the US. So they've stopped closing stores and are starting to complete the renovations. So like the new stores are much nicer looking, with a much better platform going forward. The menu and the overall perception of the brands has improved as they start doing things like loyalty programs and digital investments. And so I think they're well set up going forward.
What got me really excited, Ernest, when reading about Restaurant Brands and reading some of the transcripts is they tried to get the message across that we're halfway through this investment. And once that's over, we're going to have a ton of cash flow coming out, right? Because that's an extra, $200 million a year that it's spending that can go back to shareholders for share buybacks, for dividend increases that will really increase the free cash flow margins. And so I think it's really a question of being patient. And that's the case, right? You can't look at a stock that's down for 1 year or 2 years or down from when you paid for it and call Barry up and say, get rid of it. It's no good. I have so many examples in our portfolio of stocks that underperformed 1 year that did great the next year. CCL Industries is one where we got a lot of questions on in 2023. I think we bought it at mid 60s. It fell it ended the year down 10%. This year it's up 27%. And the results were good, and we weren't surprised that the results were good. We knew that the turnaround was going to be in play, and we feel that similar. We see that with CoStar and Restaurant Brands. There's going to be a turnaround in those earnings, and the stock will eventually follow.
Yeah, I really like what Restaurant Brands has done actually this year in terms of establishing a culture that supports the profitability of the franchisees going forward. Yeah. So these are things such as, like putting ownership back into more local operators, right? Instead of nationwide franchisees. These are things such as, like really taking a look at all the menu items to ensure that like they're driving incremental transactions for the franchisees, right? And I think this is what's going to ultimately drive growth going forward, rather than what's the stock price doing year in or year
Yeah.
out.
And it doesn't hurt that McDonald's is giving people E. coli. So moving on to top performers and things that, obviously we're very pleased about. Netflix, of course, best performer so far year to date, almost a double in its share price. Everything worked perfectly for Netflix. The playbook of 2023, where they were telling they were going to crack down on the password sharing, launched the advertising tier. Those things all worked out, but also their competitors all got worse, and Netflix had some pretty amazing new programming, either whether the Mike Tyson fight or launching wrestling coming up or live comedy or new shows that have become home runs for it. Everything is working amazing for Netflix. So what do you do with the stock here?
Yeah, so I think
Yeah.
if I look at the top performers
Yeah.
on the list,
Yeah.
there's Netflix, which is almost double.
Yeah.
There's Garmin, Costco, Amazon,
And the two Brookfields.
Live Nation, and the Brookfields.
Yeah.
And there is a common theme among these companies, which is that they had very strong 2023 in terms of financial performance. And I think the market was thinking that a lot of the performance in 2023 was merely a rebound of what happened in 2022.
Okay.
So like Netflix, for example, like they were not in too great of a place in 2022.
No,
We've talked about this before many times.
Yep.
And they did a bunch of initiatives, and then 2023 was much better.
Yeah.
And I think a lot of people thought that this was just like a one-time boost to the company. What ended up happening for companies like Netflix and Costco and Amazon and Live Nation is that these are secular growth companies. So they benefited from the rebound in demand in 2023 off of the things that they did due to 2022. But then they continued to build on that in 2024, and the results were much better.
Yeah.
So that's why these stocks were up so much.
Yeah. So if I look at the company, I think you hit the nail on the head exactly right. There's nothing in those companies that you mentioned where they came out with like a new amazing product, or all of a sudden they're like a quantum computing, AI, robot, something crazy.
Developing parallel universes.
Whatever it is, there's nothing that was like, boom, holy crap, it came out of nowhere. All the performance was due to the groundwork that these companies laid over the last few years, right? Live Nation, we argued for years that the stock was undervalued. We argued that the market misunderstood how to value the company. Luckily the company is smart enough to grow into different areas and benefit from so many great concert tours, but also doing the right things, making investments in new venues and just being able to handle all the volume with its amazing Ticketmaster business, right? And same thing with Brookfield. I don't think Brookfield did anything different, right? It just, we argued for years that market is not valuing it properly. Market doesn't recognize the real estate is not worth negative value on the balance sheet. That's stupid. And, finally these things came through. It doesn't hurt that we also had a bull market.
Yeah, I would say that these names are certainly not as attractive as they were last year.
Yeah.
But I don't think the story has changed. But if anything, like I think this year has shown that the market is finally starting to appreciate what great businesses these are.
Yeah.
And that I think they'll continue to do that in the future.
And I agree with that point for sure. Netflix is no longer obviously cheap. At one point, you could have bought Netflix. I think Netflix is going to earn $20 a share next year. At one point, you could have bought it for like 10 times earnings, or 15 times earnings, even 20 times earnings. And now it's finally recognized as a very well-run, terrific, ultimate, inevitable company. Costco, of course, you could have argued that it was expensive at $300 or $400 a share.
And we did. We thought that.
Yeah.
Like if I look at my notes, we thought it was, like possibly stretching the valuation, but great business, and tripled from there.
Yeah. So I don't think will get the benefit of the tailwinds of a lot more multiple expansion going forward. It may be more difficult to achieve better returns, but that's going to be our problem.
Yes, and like you said, that's a good problem to have,
Mm-hmm.
and it's something that we will react if necessary.
Absolutely. So anything, so let's, I mean, I think that was a great summary of our portfolio for 2024. Your thoughts as we head into 2025, anything that sticks out to you in our portfolio that you want to talk about, or maybe some things that you're thinking about in terms of how the economy or the markets will play out, or some themes?
I think a lot of people are, like wondering about how the general Trump presidency will work.
Yeah.
I don't really have anything interesting to say about that. I think what is interesting and quite relevant to our portfolio will be what ends up happening with the Department of Justice and its various antitrust regime
Good
towards
point.
companies overall. This impacts quite a few names in our portfolio, including Alphabet, Amazon, Live Nation, Meta. I think that time will tell what approach the Department of Justice and the FTC under Trump will take towards these companies. But that will be probably the largest thing that I will be paying attention to in 2025. In Canada, I think one thing to be quite excited about is the completion of LNG Canada, which is the first ability of Canada to export natural gas to foreign markets. That's a potentially big catalyst for some of the Canadian energy names that we own, including Canadian Natural and Tourmaline. And beyond that, I think we look forward to good execution overall.
Absolutely. It will be an interesting year, Ernest. We've seen a gigantic build out of data centers and spending on NVIDIA chips and you name it for what companies expect will be an unbelievable amount of data and demands from AI going forward. We'll have to see how that plays out, but we think we're in the right place, owning a number of companies that should benefit from if that growth continues. Also big themes, of course, climate change, decarbonization. Some of those things don't go hand in hand with data center and electrification of the grid, but these are some interesting themes that we'll see. We'll have to see how the Trump presidency plays out in terms of if he's going to follow through on some of his threats in terms of tariffs or big changes that may have come to the economy or the tax code. We will be watching, of course. I think there'll be an election probably in Canada in 2025 as well. So that will be an interesting thing to keep on our radar. We expect, of course, interest rates in Canada, especially on the short end, to come down. A lot of people expect that will put a pressure on the Canadian dollar, which is already near a multi-year low. I think the Canadian dollar fell below 70 cents during the height of the pandemic. There was a lot of volatility at that point in time, but it's getting back to those levels. If the Canadian economy cuts interest rates faster, it could lead to more pressure on the Canadian dollar, although impossible to tell. It does seem, Ernest, that interest rates on the medium end have kind of stabilized as it's pricing in inflation, at least maybe being stable here as well as a pretty decent economic growth. And so that could be at least decent returns for bonds going forward. And so no idea what the stock market's going to do. We're not going to give you a prediction. We're not going to say whether it's going to go to 7,000, the S&P 500 or 5,000. What we want to focus on is owning a basket of companies that we think can deliver double-digit returns, total returns over the long term. And I think we're well set up. I'm really pleased with how the portfolio looks today. I think we did a great job of maybe eliminating some more mature businesses and owning some faster growing businesses. We'll have to obviously look at some of the larger positions in our portfolio as we head into 2025. We don't want to take a lot more capital gains. 2024 was a larger year for us, so we did some trading. We paid capital gains. And there's some significant capital unrealized gains in a lot of the stocks at the moment. So that's really it for all I got. Anything else you want to add?
No.
So we're going to wish everybody a happy holidays. We really appreciate the growth in our viewership and listenership this year. Ernest and I will be back here in the new year. And so we wish your families a safe and happy and healthy holidays. Happy New Year. And thanks so much for listening. And we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.